At 6.7%, everyone I talk to wants the same thing. They want to assume someone's 3% mortgage from 2021. I get it, the gap has never been wider. But here's the truth about who actually can do this and why most people asking about it right now are going to be disappointed. I'm Connor Webb, mortgage loan originator here in Clark County, Washington. Today I'm going to break down what assumable mortgages actually are, who qualifies, the catch that nobody mentions, and exactly when this does and doesn't make sense in a 6.7% interest rate world. This is Living in the PNW. Make sure to subscribe if you want mortgage, real estate, and Clark County news that's actually honest. And the part that trips up almost everyone who gets excited about this, the gap between what you're assuming and what the house actually costs. That's where the dream usually falls apart. Let me show you why. First, let me explain why this conversation is happening right now and it wasn't happening 2 years ago. In 2021, a lot of buyers locked into rates in the 2.5 to 3.5% range. At 6.7% today, that's a spread of 3+ percentage points. On a $500,000 home, that difference in rate can mean $600, $700 a month or more in your payment. So the appeal is obvious. If you could take over a seller's existing loan at 3% instead of getting a new one at 6.7%, that's a massive amount of money saved. The idea is real, the mechanic exists, but the fine print is where it gets complicated. So here's how it works. In an assumable mortgage, you take over the seller's existing loan, their balance, their rate, their remaining term. Instead of getting a brand new mortgage at today's rate, you step into theirs. Now here's the first filter. Not every loan type allows this. Conventional loans, which are the majority of mortgages out there right now, generally don't allow an assumption. The loans that do are primarily VA and FHA loans. So right off the bat, the universe of homes where this is even possible is smaller than most people think. Here's the catch that nobody mentions, and it's the reason most people who get excited about assumable mortgages walk away without one. Let me paint the picture. A seller bought their home in 2021 for $400,000 at 3% interest rate. They've been paying it down, so the remaining loan balance is maybe $360, $370, but the home has appreciated. It's now worth $500,000. If you assume their loan, you're assuming the $360,000 that's left, but you owe the seller $500. That gap, that $130,000, $140,000, you have to cover it somehow. That's either a massive amount of a down payment or you need a second loan to bridge it, which comes at today's rates, and that second loan partially defeats the purpose of assuming the cheap first one. That gap financing problem is why most buyers who want to assume a loan end up not being able to. The math only works cleanly when the seller doesn't have a lot of equity, which is not common for someone who bought at the bottom and held. A couple more things to know. If you're assuming a VA loan and you're not a veteran yourself, you'll typically pay a VA funding fee, which can be a significant amount at closing. And the assumption process itself takes longer than a standard purchase. You're waiting on the lender's approval of the assumption, which can take 60, 90 days, sometimes more. In a market where sellers have other offers that close faster, that's a competitive disadvantage. So when does this actually make sense? A few specific situations. The seller has relatively low equity, so the gap is manageable. You have enough cash to bridge it without a second loan, or the second loan math still nets you a better blended rate than a single new mortgage at 6.7%. And you can wait out the longer close timeline. When all that lines up, an assumable mortgage at 3% versus 6.7% is genuinely one of the best deals in housing right now. It's just not the broad solution people want it to be. And if you're self-employed and you're wondering whether any of this is even available to you, start with the more fundamental question first. Can you qualify for any mortgage at all with your current income documentation? I made a full video on bank statement loans, how they qualify you on deposits instead of tax returns, and why that path matters more than ever, especially at a 6.7% interest rate. That one is going to be linked below. So if you're curious whether an assumable mortgage is actually an option in your situation, there's a link in the description to book a clarity call. We'll look at the real numbers and give you an honest answer, not a headline. If this is helpful, make sure to subscribe. I'll be covering the stuff that actually matters for your money. Thank you for watching, and we'll see you in the next one.